Why don't bonds care about the big PPI miss? Hey guys, it's Mortgage Mel, and it's time for today's Mortgage Minute. At first glance, it looks like today's PPI data should have rattled the cage of the bond market. After all, core PPI jumped to zero point 0.7 from 0.2%, and last month it was 0.0. If we saw that kind of surprise in CPI, then it wouldn't be unusual to see bond yields going up at least 10 basis points. So, why the shrug from bonds? Let's take a look. PPI is much more volatile than CPI. So, PPI often swings around due to factors that don't reliably feed through to consumer prices. Because of that, markets are conditioned to be skeptical of any single PPI print, especially a big one. Bonds care about consumer inflation, not producer noise. PPI matters mainly for what it implies about future consumer inflation. To assess that, traders focus on the specific PPI components that flow into PCE inflation, the Fed's preferred gauge, not the headline or even the core number. And those key components weren't nearly as hot. When you strip PPI down to the categories that actually affect PCE, today's data looks far less inflationary than the scary headline suggests. In other words, the parts that matter most didn't confirm a surge in consumer inflation. Why this matters for mortgage rates. Mortgage rates follow bond yields, and bond yields respond to sustained inflationary pressure, not one off volatility. Since today's PPI didn't meaningfully change expectations for future consumer inflation, it didn't give bonds a reason to sell off. The bottom line, a massive PPI miss grabs headlines, but bonds are looking past it until producer price pressure consistently shows up. Bonds are likely to overlook it. For today's mortgage rates, that means no sudden damage, no inflationary pressures yet. And I think they're just waiting for more clear signals as to where the inflation is going to go. I hope this information helps. If it does, give me a like and a follow, and I hope you have a great day.